Hey, what's going on, guys? Let's talk a bit about in terms of how to invest in stocks. Been getting a lot of questions from beginners in terms of how to invest. So let's talk about it. When you talk about investing, right, what you want to really take a look at is in terms of what your investing style is. A couple of ways you can do it is, first of all, you can always do it invest by yourself. So if you invest by yourself, you have two options. Number one, if you have nothing really to do, or you can spend some time maybe in the first half of the day or maybe in the second half of the day. You can do day trading, right? So day trading is where you are holding positions only during the day, right? So you are buying something and you're selling it by the end of the day. So we're looking at between 9:30 a.m. and 4 p.m. If you have time to trade, then that's when your trading session is. So either you're able to trade at the beginning of the day or maybe able to trade maybe in the later part of the day, right? So if you buy something, you want to sell the particular stock, or get rid of the position by the end of the day. So that's day trading. The other way you can really do investing is via swing trading. Now, swing trading is like holding positions overnight, right? So if you buy something, let's say you decide to buy a stock called Apple, and the stock does really well, you want to hold it either for a day, weeks, or even months, right? So that's swing trading is like an investing where you are holding positions for a longer time. So you have to determine how much time do you have to invest if you want to invest by yourself. So those are the two opportunities you have. Next is you can invest through someone else, right? So let's say you do not have the time to go and do the research on which stocks to day trade or which stocks to swing trade. You can do investment through an investment advisor, right? So the investment advisor role really is to give you recommendations on what stocks to buy based on your risk tolerance. So maybe if you are more aggressive type, you're looking at more on the growth stocks like Apple, Facebook, Google, Netflix, Tesla, and so on. Or if you're more of the boring type, maybe you want to buy some bank stocks or telecommunication stocks or utility stocks, right? Something like the Wells Fargo, the Bank of America, right? So something which is large, stable, been around for a while. Hopefully it won't go under. So it's large enough, right? The other way to invest, if you want to do it through someone else, is through mutual funds. With mutual funds, what you're really doing is having the portfolio manager pick which stocks to buy. So instead of you to actually sit down, so in this differentiation between investing by yourself or through someone else really is, if you have time to trade and decide which stocks to buy, then you want to be looking at on a daily basis, then you want to invest by yourself. If you do not have the time to do that research, then you want to be finding an investment advisor or mutual funds, right, which have proven history, and that's something you can fall back on. So let's understand the difference, right? So basic investing by yourself, you have to do the research and select which stocks to buy, when to buy it, and when to sell it. If you do invest through someone else, the only differentiating really is you do not have to determine which stocks to buy. Rather, you have to determine the investment advisor or the mutual fund, the portfolio manager, look at their past history and see how have they managed the markets and the historical numbers, and hopefully they are continuing what they have been doing, and you can try to see how they will do in the future, right? But there are no guarantees of investing through advisor as well. I mean, they can go through bad times, bad trades, and so on, right? So now when you talk about investing, you also look at a couple of options, right? Stocks, ETFs, or mutual funds. So stocks. A stock is market equity. A share market is an aggregation of buyers and sellers. It represents the ownership claims on a business. So it could be something like an Apple stock. You can definitely go and buy it. So you can be a part owner of the Apple company, right? So it's always good to own the company rather than the product. So in this situation, you want to buy an Apple stock rather than buy an Apple phone. The other way to invest is through ETFs. Now ETFs are exchange traded funds. It's a marketable security that does track an index. So when you talk about an index, you're looking at, let's say you look at the S&P 500, you're looking at the S&P 500 index. If you look at the NASDAQ 100, you're trading the NASDAQ 100 index, right? Third, you can invest through mutual funds. So mutual fund is going to be a collection of stocks and bonds. So depending if you want an equity mutual fund, it's going to have all equities in it. So it's being managed by a portfolio manager, and you have a professional investment company who's managing the funds. So when you put money into a mutual fund, it is combined with money from similar-minded investors. So you are not buying a particular stock by yourself. What you're really doing is you're buying the particular mutual fund, and the portfolio manager is going to take this money, and now they're going to decide how to allocate this money based on what your ideas are. Ideas in the sense that which stocks to buy and so on, right? Now, in terms of how much do you have to invest, right? Now it comes down to how much do you really have. If you have something below $50,000, what you can start out with mutual funds, or you can even start out with, say, low fees ETFs. Now, the challenge that you will find really is if you have under $50,000, if you have mutual funds, yes, there is management fees in it, and the MERs can really vary between 1 and 2%. So, I mean, is there a value to it? Yes, there is value to it in the sense that you don't pay a trading commission when you go and buy a particular mutual fund. Right? With most brokers, you can buy a particular mutual fund, whichever one you decide. So you can actually buy it. When you talk about, so it's not really low fees, but you can definitely go and buy it depending on which mutual fund you're buying. The other way to invest is if you have more than $50,000, right? So the good idea really is accumulate funds in a mutual fund, and hopefully your account is more than $50,000, and now you can go and start investing in ETFs or stocks. Because once you go and buy ETF or stock per trade, you might be trading, say, per trade. If you want to buy 100 shares of ETF, you might have to pay $10. You might have to pay $5 per, right? $5 per trade or $10 per trade, whichever discount broker it is. So it's not really beneficial for you to go and start putting money in ETFs or stocks if you have under $50,000. So let's say, for example, if you have, say, $1,000 to invest, right? I mean, if they charge you, say $10 per trade, so right off the bat you're down 1%, right? Because if you do $10 divided by $1,000, that's 1%. So 1% of your money is gone, right? So now for you to break even, you actually have to make 1%. Now keep in mind, when you do go sell the particular ETF or stock, you have to pay this $10 per trade again. So it means you're down 2%. So that's why you can start out with mutual funds. You have the full amount to actually invest in it, right? So in the future, when you do go and sell it, you don't have to pay any transaction fees for mutual funds. Where ETFs and stocks, you will have pay those transaction fees. So next thing to really do is to open an account. So the most popular ones is discount brokers like Interactive Brokers, TD Ameritrade if you're on the US or the Canadian side. Or if whichever country you're in, just go and Google discount broker and put in your country name. They're going to show you a whole list, and you can go and select which one you like. If you do like the video, do like and subscribe. I'm going to make more videos to keep you guys profitable. Have a good one.